Hi, this is Lara with your end of the week analysis for the gold spot market for the trading week ending Friday the 2nd of February. It still looks like a consolidation is underway. It can be as time consuming as a Fibonacci 13 or possibly even 21 weeks, and so it may not be quite halfway through. It's also possible it could be a quicker, sharper pullback. When it's complete, it's most likely at this stage the upward trend may resume. However, if we see a new low by any amount at any time frame below 1236.54, then we would expect gold remains within a huge bear market, and we would expect new lows below 1046.27. Elliott wave analysis first, classic analysis last. In order to make the analysis manageable for me and digestible and understandable for members, I'm only going to produce one bull and one bear market on one bull and one bear wave count on a daily basis, and I'm going to refer you back to the last historic analysis that I did last weekend, which I will link to at the beginning of every article every day. In that, there are 5 weekly charts. At this stage, the analysis sees prices most likely within a B wave at cycle degree. B waves are the absolute worst. They exhibit the greatest variety in structure in terms of Elliott wave and behaviour in terms of price. And so about the point where you think you might be about halfway or so through a B wave, usually the number of structural options open for the wave count is quite a lot. And so I presented 5 of the most obvious ones I can see, and I'm only going to produce 2 on a daily basis. We need to consider the bullish and the bearish case. On all of those charts, I have identified quite clearly if there are problems within the wave count. This first wave count and the second will both look at the possibility that cycle wave A was over down here and cycle wave B begins here. This first wave count looks at cycle wave B as a single zigzag subdividing 5, 3, 5, and primary wave C of the zigzag and ending expanding diagonal. Ending diagonals must have subwaves, all of them subdividing as zigzags, and the fourth wave of a diagonal must overlap first wave price territory. In order to tell others that you expect it's a diagonal in your wave count, you should always put the trend lines in. So that's what I've done here. So this diagonal for primary C has a zigzag for 1, a quick zigzag for 2, a zigzag for 3 and 4, and now we're expecting a zigzag for 5. In order to figure out how long minor wave B within this zigzag may last, we can look to the last B waves within these zigzags. Here, minor wave B at the weekly chart lasted about 8 weeks, a Fibonacci 8 weeks, and here, within intermediate wave 3, minor wave B lasted 12 weeks. Within intermediate wave 2, minor wave B was too quick to show up on the weekly chart, and within intermediate wave 1, minor B lasted just 1 week. And so as the diagonal continues, it's an expanding diagonal. The waves, the actionary waves, are getting longer, and the reactionary waves are getting longer as well. So 4 is longer than 2, and 3 is longer than 1. That means, in order to meet the rules regarding wavelengths for an expanding diagonal, 5 needs to be longer in length than 3. If it's going to be longer in length than 3, then it's probably also going to be longer in duration. That would make sense, wouldn't it? Which means that within it, minor wave B may very well be longer in duration than minor wave B within intermediate wave 3. So far, minor wave B has lasted only 1 week, and so it's quite likely to be only within its very early stages, not yet halfway through. If my labelling at the daily and hourly chart levels is wrong in terms of degrees of labelling for minor B, it's going to be too high. So let's look for minor wave B to last a Fibonacci 8 weeks. In our shortest expectation, it could be as long as a Fibonacci 13 or possibly even 21 weeks. And there are multiple structural options for minor wave B. It may not move beyond the start of A below 1236.54. The minimum requirement for this wave count for upward movement is for price to move or end above 1398.41. Because the ending diagonal is expanding, that means that intermediate 5 must be longer than intermediate wave 3. It would reach equality with intermediate 3 at this price point, so it needs to end above that point. That would see primary C move above the end of primary A and avoid a truncation. Okay, let's take a look now at the daily chart where the end of intermediate 4, low down here, is this point down here. Intermediate 5, if this is an fifth wave of an ending diagonal, must subdivide as a zigzag. Zigzag subdivide 5, 3, 5. So far we might have only minute wave A complete, or we could move the degree of labelling here down 1. Minute wave A could be incomplete, and this could just be minuet A of minute wave A. While minor wave B unfolds, the labelling within it will change. At this early stage, there are still more than 23 possible corrective structures that minor wave B can take. It's absolutely impossible for me to tell you at this stage, or even until either very close to the end or at the end, which of those multiple structural options it has taken. It's essential when B waves are unfolding that you exhibit patience and flexibility. Alternate wave counts will be required, and you have to understand that as it unfolds, the labelling within it will change. This B wave may be either analogous to a range-bound, time-consuming consolidation, or it could also be a quicker, sharper pullback. And again, it's impossible for me to tell you at this early stage what kind of shape this correction is going to take. All I can tell you for this main wave count is B may not move beyond the start of A below this point. It may well end about the 0.382 or the 0.618 Fibonacci ratio of minor A, and we can favour neither of those. B waves exhibit huge variety. There is no most common tendency of which Fibonacci ratio it's going to correct to. The arrow here outlines one of the most common pathways it may take. This arrow does not mean this is how minor B must unfold or will unfold. It's just outlining for you one of the most common tendencies that it might unfold as. It may be an expanded flat subdividing 3, 3, 5. Within an expanded flat, the B wave moves beyond the start of the A wave. Actually, the arrow shows a regular flat, not an expanded flat. An expanded flat would see minute B end above the start of minute A, because expanded flats have B waves which are a minimum 1.05 the length of the A wave. And again, we could move the degree of labelling here down. Minute A could also itself be an expanded flat. At the weekly chart level, just before I go into this one, I want to draw your attention to this structure here. This is a really good example of an expanded flat, and it's a B wave. Expanded flats subdivide 3, 3, 5. They have within them a B wave, which makes a new price extreme beyond the start of the A wave, and when the B wave is complete, the C wave moves comfortably beyond the end of the A wave, and the C wave is usually 1.618 or 2.618 times the length of the A wave. The key to identifying an expanded flats when the B wave unfolds, the first thing is they should be a three-wave structure, almost always a single or double zigzag, and they should have some inherent weakness. Usually they have lighter volume, and usually at their price extreme they exhibit some good, clear, strong divergence between price and RSI and price and stochastic. So you should see some weakness within the B wave. Best way to identify them. So I'm expecting that for the current, that first wave count, we could be looking at something like this. Now the problem with expanded flats is because the B wave does make a new price extreme beyond the start of the A wave, they try and convince us, and they do manage to convince most traders, that the correction or pullback is over and the trend, the prior trend, is resuming, and they do that right before a strong C wave makes a new price extreme beyond the end of the A wave. So it's quite important to be open to the idea of an expanded flat and consider the duration of the correction you're expecting. Okay, let's dive into this wave count now. Cycle wave A still ending here, and now I'm looking at another structural possibility for cycle wave B, because remember I've got 5 weekly charts, and this is the most immediately bearish weekly chart, which is why I'm publishing this one as a second idea. It looks at cycle wave B as a flat correction, subdividing 3, 3, 5. Within it, primary wave B still has to meet the minimum requirement for a flat correction. It has to reach down to 1079.13 or below, where it would be the minimum 0.9 length of primary wave A. It hasn't got there yet, so it can't be over here if cycle B is a flat. Now turning our attention to the structure of primary wave B, this itself could be subdividing as a flat, a regular flat, subdividing 3, 3, 5. In order for this to be seen as a regular flat, we have to see intermediate wave B, if it's over here, as a triple zigzag. The subdivisions fit really very well indeed. The only problem I have here is triple zigzags are very rare structures. If this is a triple zigzag, then in my now 10 years of daily Elliott wave analysis, it would be only the third triple zigzag that I have ever seen. And so they are very, very rare, rarer than running flats. The rarity of this structure must necessarily reduce the probability of this wave count. Pretty much every single one of those weekly charts does have a problem, and I have identified the problem in terms of probability on the weekly charts. This one is the rarity of a triple zigzag. Let's consider it is entirely possible though. We need to see a new low below 1236.54 in order to have enough reasonable confidence in this outlook. At that stage, we would then expect that we're in a 5-wave structure down for intermediate C, and the target would be 1.618, the length of intermediate A, at 958. Even though primary B would be a regular flat, that's the Fibonacci ratio I'm using for the target, because that is the Fibonacci ratio required for primary B to meet its minimum requirement in relation to primary wave A. Were intermediate wave C to only reach equality in length with intermediate wave A, this minimum requirement for primary B would not be met. So intermediate C would reach that target at 958. And when that's done, and primary B could be a complete regular flat, this wave count would then expect a huge 5-wave structure up for primary C to move beyond the end of primary wave A to avoid a truncation and a very rare running flat. At the weekly chart level now, let's have a look and see what's happened this week. Last week we had a bit of a longer upper wick and we had quite a strong volume spike that looked a little bit like a blow off top. Now we've got an inside week, the balance of volume is down and it shows a decline in volume, and so during this week the fall in price did not have good support from volume, so that's slightly bullish for the short term. The bigger picture though, looking at this weekly chart, sees that we've got strong resistance here about 1375, and we've got a good zone of support, although it's quite a wide support zone down here, about 1240 to just below 1200. Gold remains range bound at the weekly chart level within a huge range. It's swinging from resistance to support, and back again. And so we can use stochastics in conjunction with price and resistance and support to try and tell us when one swing ends and the next begins. Stochastics has reached overbought, price has reached up into our resistance zone, and so it seems entirely reasonable to expect an end to the upward swing here, a curve down and a move down to about support. In the first instance, there's a strong zone of support within this larger consolidation zone, about 1305 to 1310. On balance volume gave us a bullish signal with a break above resistance. It might be starting to trace out a new range. If it does, we'll have some new resistance and support lines, but for the short term, the last signal was slightly bullish. ADX indicates that we have an upward trend still in the early stages. ATR, however, doesn't support the trend. It's still very, very low, and at the weekly chart level it's not showing any indication of improving. If we're looking for an upward trend in the early stages, from the larger point of view of this huge consolidation, we really would expect to see a break above resistance, and at the daily chart level, if that happens, we'd be looking for it to occur on a day with an improvement or strong volume. That's very important, and so I wouldn't be reading this as absolutely certain until we get a breakout of this huge consolidation range. If there is a good upward trend in the early stages, that should be happening quite soon. RSI didn't reach overbought. There's still plenty of room for price to rise or fall, and we've already been over stochastics. What about the short-term picture at the daily chart level? The short-term moving average now has a downward slope and price is closed below it, and so for the short to mid-term it now looks like we may be having a consolidation within a still larger upward trend. We've got support about 1335 and below that about 1310 to 1305. There's that strong band of support and resistance there. The downward day for Friday was quite strong and it did show some support from volume. It does, however, have a bit of a long lower wick. The wick is a little bit bullish, but it doesn't mean we can't have another downward day on Monday. With support from volume for downward movement, it does look like we're probably going to get a downward day for Monday. And on balance, volume has a little bit of distance to go before it finds support. There is a bit of room here for price to continue lower before on balance volume may help to halt the fall in price when support here is reached. RSI neutral now, stochastics also neutral. Let's expect stochastics to reach down into oversold and price to reach down to support. It doesn't have to move there in a straight line though. This is the other problem with consolidations. When price consolidates, it doesn't move in a straight line. It's very choppy and it's overlapping. But overall, you'll get swings from resistance to support and back again. And then you look at the consolidation and you look to see which days have strongest volume to try and figure out what direction price is most likely to break out. We've only got a few days of this consolidation, and so far it's 2 downward days which have strongest volume, suggesting a breakout to the downside from this consolidation. If we get that, let's look for downward movement to find support around this strong zone down here. RSI and stochastics both tell us there's plenty of room for price to fall. ATR at the daily chart level is still starting to increase at the daily chart level, telling us that this upward trend, at first it was telling us this had support from increasing ATR, and now it's telling us that this sideways consolidation also has increasing range. So there's a bit of strength now possibly returning to this market. We might have a breakout from that huge consolidation zone imminently. I certainly do hope so. Bollinger Bands, however, contracting as price moves, ended its upward swing and now starts to move into a consolidation, indicates a waning trend and now possibly a consolidation, and MACD now has switched to bearish. I'm expecting more downward movement next week. The target is 2749 at this stage. In the short term, though, if we see a new high above 2183.04, that would indicate the correction may be over and the upwards trend may have resumed, that the correction would again have been relatively brief and shallow. A new all-time high next week would add significant confidence to that view. The larger trend still remains up. We will have corrections along the way within this upward trend, and they should be presenting an opportunity to join the trend. And so always practice good risk management. It's absolutely essential you always trade with stops and invest only 1 to 5% of equity on any one trade. My 2 golden risk management rules. Elliott wave analysis first, classic analysis last. My Elliott wave analysis sees a huge 4th wave correction at cycle degree over here and the start of a huge 5th wave at cycle degree. Cycle degree waves should last 1 to several years. This one's been several years, and so that fits the expectation. Cycle wave 5 has passed equality in length with cycle wave 1, and so the next Fibonacci ratio in the sequence is used for the next target, 1.618, the length of 1. If price gets up to that next target and the structure is incomplete, or it just keeps on rising, then we will use the next Fibonacci ratio in the sequence for the next ratio to cycle wave 1, that next target at 3616. And then if we get up to that target and again the structure is still incomplete or price just keeps on rising through that target, then I'm going to start to calculate targets using the ratio between cycle 5 and cycle 3, but we're not there yet. Cycle 5 has only two structural possibilities in terms of Elliott wave. It can only be a simple impulse or an ending diagonal, and the lack of overlapping very obviously tells us it's not a diagonal, this is a simple impulse. So far, within the impulse, we have primary 1 and 2. Primary 3 is incomplete. When it's done, we'll expect a big correction for primary 4 and then a final fifth wave up for primary wave 5. Primary 3 may only subdivide as an impulse. So far, we have intermediate 1, intermediate 2 complete, intermediate 3 incomplete. When it is complete, we'll then expect a big correction for intermediate 4 and a final fifth wave up for intermediate 5 to end primary 3. Intermediate 3 again may only subdivide as an impulse. So far we have minor 1 and 2, and I'm still expecting that minor wave 3 is incomplete. When minor 4 turns up, it may not move into wave 1 price territory below 2400.98. I do not think at this stage that this is minor 4, although if it lasts long enough it could be minor wave 4. When minor 4 turns up, I would expect it to be exhibiting most likely some alternation with minor 2 and quite likely to be reasonably in proportion to minor 2. It's the proportion between the second and the fourth waves within an impulse that give a 5-wave impulse what we call the right look. And that's why I'm expecting eventually when intermediate 4 and then primary 4 turn up, I'm expecting them to be reasonably in proportion to their counterpart second waves, so that the whole structure for cycle wave 5 has an obvious 5-wave look to it, which means that they should be somewhat about even in duration with their counterpart second waves. Let's turn our attention now to minor wave 3, and we're going to look past the middle of it. It had minute 1 and 2, and minute wave 3 shows a good strong increase in momentum. Third waves, and this would be the middle of a third wave at 1, 2, 3, 4 degrees, should show some strength. They should show some support from volume. They should definitely show a stronger slope, and they almost always for the S&P are extended and show an increase in momentum. And so this is exactly what the middle of a third wave should look like. This is no surprise for members of Elliott wave stock market. Let's look at the first wave count where the end of minute 2 down here was this point down here. This first wave count at the daily chart level, we'll look at the possibility that minute wave 3 is incomplete, that within it we had an extended minuet 1, a very shallow combination for minuet 2 lasting about a week and a half, a strong third wave but shorter than the first wave, which means when the fourth wave is over, the fifth wave here for this idea will be limited to no longer than equality in length with the third wave, so that the third wave is not the shortest and that core Elliott wave rule is met. The fourth wave for minuet 4 may not move into wave 1 price territory below 2694.97. This adjusted channel is it will be adjusted as an adjusted Elliott channel when minute 3 is complete, from the end of minute 1 to the last high, with a copy not on the end of minute 2, but I've pulled it down to sit on this low so that all of this movement is contained. When minute 3 is complete, then the lower edge of that channel may show where minute 4 finds support, and along the way up, the lower edge of this channel may show where minuet 4 also may find support. It might end close to the 0.618 Fibonacci ratio of my minuet wave 3, about 2748. At the daily chart level, this is a different way of labelling this current upward movement. It's identical from this point here and here, and now I'm looking at minute wave 3 possibly as complete with minuet 1 and 2 over down here, minuet 3 here with no ratio to 1, minuet 4 here, and minuet 5 the strongest end of this upward movement. Now if this is correct, then the S&P might have behaved a little bit more like a commodity. It can do that, it's just not as common for the S&P in my experience of many years of analysing this market. There is a couple of nice Fibonacci ratios here. If minute 3 was over here, then it's just 14.0 points longer than or greater than 2.618 times the length of minute wave 1. That's how to read these notations here. So there's a ratio between minute waves 3 and 1, and within the impulse of minute 3, There's a ratio between minuet 5 and minuet 3. It's pretty common for the S&P to exhibit ratios between 2 of its 3 actionary waves, and not actually all that common for it to exhibit Fibonacci ratios between all 3 of its actionary waves. So the lack of a ratio here is absolutely no problem for this wave count. If this wave count's correct, then I'd expect minute wave 4 to probably be a little bit longer lasting, and so we might be looking at an impulse down for minuet A, and then a B wave, and then another 5 down for minuet C. But in the first instance, I'd still be looking for support about the lower edge of this best fit channel. Now, price doesn't have to find support here, because here's another most unfortunate tendency of the S&P. While it's toward the end of a bull trend, and I think we're getting toward the end of minor wave 3, although remember on the weekly chart, this is only minor 3 within intermediate 3 within primary 3, so there's still a long way yet up to go. But we would be looking toward the end of minor 3 to start to see a return of some reasonable volatility to this market, and some deeper and maybe longer lasting corrections along the way up as it ends this impulse. So for this idea, I'd be expecting minute 4 to be a bit longer lasting, and when the S&P comes toward the end of its bullish trends, it does have a tendency to break bullish channels, break below them, and then price just continues on up in the same bullish direction after the breach of the channel. It does that because it likes to form slow, curving, rounded tops, and after the strong upward thrust here, that certainly could be how minor wave 3 comes to an end. So I will expect support in the first instance below this channel, but a breach of this channel does not mean the wave count's wrong. It could just mean that the S&P is forming a slow, curving, rounded top as minor 3 comes to an end. Minute wave 4 may not move into wave 1 price territory below 2490.87. At the weekly chart level, let's expand that quite a lot. No, expand, not contract, Lara. We've just had the strongest week we've had in a very, very long time. I've gone over Neeson's description, it's the candlestick expert. I've gone over his description of a bearish engulfing candlestick, and because this weekly candlestick doesn't actually properly engulf the prior weekly candlestick, the open here has gapped lower. There's not a proper engulfing candlestick. It's not actually properly technically a bearish engulfing candlestick. However, having said that, the most important part of a bearish engulfing pattern is the close of the second candlestick, that it closes below the open of the prior candlestick. And this one's not only closed below the open of this, it's closed below the open of the one the week before as well. This is a very, very strong bearish candlestick pattern. I'm not going to technically label it a bearish engulfing pattern. I like to be absolutely accurate. It's a strong bearish candlestick, and it has support from volume. So for the short term, that's a strong bearish signal. On balance volume remains very bullish though, and we've got no bearish signal from on balance volume at the weekly chart level, and we didn't have divergence between price and RSI at the highs. RSI is now moving back into neutral. I'm expecting as this bullish trend continues, we're going to start to see more long-lasting and deeper corrections. So this is absolutely okay. It does not mean the bull market is over. It just means that we're seeing some volatility returning to this market. The bull market still remains intact. ADX tells us that the upward trend reached very extreme, and it stayed very extreme for several weeks. It's still very, very extreme. It's above both 35 and it's above both directional lines. That's been able to be maintained for quite a long period of time now. And so again, it's quite reasonable to start to expect to see some volatility return and some corrections start to return to bring ADX back down from very extreme. It doesn't mean the bull market is over. And MACD does remain bullish. It is, of course, a lagging indicator. What about the short-term picture? That was a pretty strong bearish candlestick for Friday. Price is now closed below the short-term Fibonacci average. It's done it before, but not with strength like this. And so this is the first reasonable, decent-sized correction we've had in quite a long time for this bull market. And that's absolutely normal. There will be corrections along the way. This day does not mean the bull market has ended. It just means that after a very strong bullish run up here, we're starting to see some volatility return. In terms of Elliott wave, after the middle of a third wave, we're starting to see the first of a decent size fourth wave correction turn up, which is exactly what you'd expect to see in a normal bull market after a strong bullish run. The mid and the long-term moving averages still have positive slopes. Price is still above both of those, although it's closed below the short-term average. So let's look out for support about this mid-term Fibonacci 55-day moving average in the next instance. Just a little bit below that, we've got some support about 2700. So if price closes below this purple moving average, let's look for support about 2700. Friday's strong downward day did have some support from volume, not as strong as a couple of days ago though, so it is bearish but not hugely bearish. Because there's a bit of support from volume though, let's look for possibly another downward day for Monday. If we start to see a candlestick develop on the daily chart that has a long lower wick and a shorter upper wick, then I'd be looking possibly for a low in place. ADX at the daily and weekly chart had reached very extreme on both those time frames. It was above 35 and above both directional lines. ADX is now declining, and that tells us at this point in time we may be in a correction or consolidation. The upward trend may have temporarily halted. ATR is rising as price falls. That's bearish. That's actually pretty normal for the S&P. On balance, volume's given us a bearish signal on Friday, but unfortunately the signal is actually quite weak. This trend line was only just able to be drawn. You need 2 points in order to draw a trend line, and now it's broken. This trend line is not strong at all. It offers weak technical significance, and so this is a weak bearish signal, but nevertheless it is a bearish signal. And this pullback has brought RSI down from overbought into neutral, and it's brought stochastics from overbought into neutral. And so again, there is now room for price to rise again, but for now there's also room for price to fall a little bit further before this consolidation or pullback is done. And MACD switched over to bearish a couple of days ago. As downward movement continues, Bollinger Bands are now contracting. That's pretty normal when price is consolidating, so that does offer a little bit of support to the idea that this downward movement at this stage may be a consolidation, still within an upward trend, although Bollinger Bands can behave in the same way early on within a trend and toward the end of a trend. What about VIX in the AD line? Volatility has had quite a strong increase in the last few days. I'm going to read this as bearish. Now, the traditional interpretation would be that this is hidden bullish divergence, but I'm going to read volatility at this time as more of a leading indicator in line with how I interpret market breadth. We've got some very strong increases in volatility, but price has not managed to make corresponding new lows compared to the same points in time for inverted VIX. And so I'm going to read that at this stage as volatility tells us that we might be going to see some more strong downward movement from price before this pullback is done. I'm a little bit more confident with that reading with the AD line though. According to Lowry's, the AD line should be read as a leading indicator, not a lagging indicator, which means that the AD line making a new low beyond this prior point back here, and yet price failing to make a new low. If the AD line is a leading indicator, it means that price may well follow through. At least for the short term, this is bearish for price and supports the idea that the downward movement wasn't over for Friday. We're going to see a bit more downward movement. And looking at this candlestick for Friday, this is so bearish. I certainly would be expecting we could see a bit of sideways movement first, but I'd be expecting new lows next week from the S&P, and I won't be expecting it to find its low until we start to see some long lower wicks on at least one daily candlestick, and maybe price moving down to support and stochastics moving down to oversold, and then I'll look for a low and the resumption of the upward trend. For the short term, assume that the upward trend remains intact while price remains within that yellow channel on the daily chart. Only if that channel is breached by downward movement can we assume that a high is likely to be in place. For the short term, if we see a new high above 74.96, that would provide a very strong indication that oil may be in a longer term bull market. That's my alternate wave count. The target for the short to mid term would be 80.64, but along the way up, we'd be looking for another big consolidation before that target is reached. For the short term, my main wave count still expects that we should be seeing a trend change here and a new low to end below 26.86. Let's do the Elliott wave analysis first, classic analysis last. My wave counts see a first wave at supercycle degree over here, and this first wave count looks at a second wave zigzag continuing, subdividing 5, 3, 5. Of all of this chop here, this is the high, and so to see cycle B over here and cycle C beginning here has the best look in Elliott wave terms. Cycle wave C, if this is a zigzag for supercycle 2, must be a 5-wave structure. The C wave may so far be unfolding 1, 2, 3, 4, 5. There is almost perfect proportion between 2 and 4 here on the monthly chart. They both last about 22-23 months. It's the proportion between the second and fourth wave corrections within a 5-wave impulse which give a wave count what we call the right look. The third wave subdivides beautifully as a 5-wave impulse. The only problem here is the fourth and second waves would both be single zigzags, and within them, their B waves would both be contracting triangles. But there is some alternation in terms of depth. Primary 4 is deep in relation to primary 3, and primary 2 is very, very deep in relation to primary 1, much deeper than 4 in relation to 3. So there's some alternation. Here's the bottom line, the price point, which clearly differentiates the two wave counts, and that's one of the nice things and one of the useful things about Elliott wave. Because Elliott wave rules, all bar one, are absolutely black and white, as soon as a price point is breached by any amount at any time frame, invalidating a wave count, then you can discard that wave count and go to the next likely wave count. Alternate wave counts should be used, particularly at points where they diverge from other wave counts, and they use invalidation points to differentiate between them. If 4 moves above 74.96, this wave count would be invalid. I would discard this main wave count in favour of the much more bullish alternate. But while price remains below this price point, this is still going to be my main wave count because in Elliott wave terms it still has overall a better fit and a better look. Let's take a look at how primary 4 maybe have unfolded, where the end of 3 down here is this point down here. It subdivides quite nicely as a zigzag, 5, 3, 5. Intermediate wave B is a running contracting triangle. All of the subwaves are zigzags. The double zigzag is minor wave C, and that's the most common triangle subwave to subdivide as a more complicated multiple. And E falls quite nicely short of the AC trend line. That's the most common point for E waves of Elliott wave triangles to end. From this low to this high, this wave count sees this upward wave as a 3-wave zigzag, 5, 3, 5. There's some disproportion here between this fourth wave and the second wave, but it is disproportionate, but it's still not as bad as a problem with the alternate wave count. So in terms of Elliott wave, this wave count actually has a better look at the weekly time frame. Intermediate wave C must be a 5-wave structure. It looks like it may be an impulse subdividing 1, 2, 1, 2, 3, 4, 3, 4, and the fifth wave may be over here with an overshoot of the upper edge of that big teal channel. That's not enough of an overshoot to invalidate or discard this wave count. Only a new high above 74.96 by any amount at any time frame would be enough to invalidate this wave count. If primary wave 5 were to reach only equality in length with primary 3, it would end in length with primary 1, which would be the most common Fibonacci ratio for a fifth wave to exhibit. That calculation would see it truncated, so it may not exhibit a Fibonacci ratio to primary waves 1 or 3, but I would expect it to end below 26.86 so that it avoids a truncation. So in the first instance, that's the expectation for this wave count. A target for primary 5 may best be calculated at intermediate degree. That can only be done when intermediate waves 1, 2, 3 and 4 within it are complete. That can't be done yet. At the daily chart level, this is a look at intermediate wave C. It subdivides very nicely as a complete impulse still. Importantly, when I look at this little piece of movement on the hourly chart from this high to this low for the week, it can subdivide either as a 3-wave zigzag or a 5-wave impulse. This first wave count would have to see it most likely as a 5, but it could be a zigzag if a leading diagonal is beginning to the downside. Quite often, oil does begin its new trends quite slowly with a fair amount of overlapping. At the monthly chart level, this is an alternate. It's the same to this point here, and now I'm still looking at supercycle wave 2 as a zigzag, but if primary wave B didn't end here, it could have ended here, and if you see, cycle wave B, if you see cycle C beginning here rather than here, now it will subdivide nicely as a completed 5-wave impulse, which means supercycle 2 could be a complete 5, 3, 5 zigzag. In order for cycle wave B to end here, this price extreme here has to be part of primary wave B within it, which will subdivide very nicely as a not very common 9-wave triangle. There's no truncation here. Primary C moves beyond the end of primary A. That's the differential, that's the defining factor for a truncation. It's where C ends in relation to A, not where C ends in relation to any price extreme of B. And so there's no problematic truncation to reduce the probability of this wave count. This wave count is entirely viable. If supercycle 2 is over here, then the first 5 up for cycle 1 would be incomplete. Let's look at this at the weekly chart level, because there are some problems in here where supercycle 2 is this point down here. This is no problem. Primary 1 and 2 subdivide okay. This is a problem. To see intermediate wave 1 over somewhere here, we have to see it from this low to this high as a 5-wave structure. And there's such a huge gross disproportion between minor 4 and minor 2 that really is somewhat problematic. This piece of movement has a better fit for the main wave count than it does here for this alternate, which is one reason why this is an alternate. But let's consider all possibilities. What if the main wave count is invalidated with a new high above 74.96? That would send a very strong signal that oil may well be still in the relatively early stages of a huge new bull market. Primary 3 may only subdivide as an impulse. We may have 1, 2, 3 nearing completion, and then 4 has to remain above 1 price territory, and then a final 5th wave up. At the monthly chart level, let's have a look at some classic analysis and see how much support for either of those wave counts there is. On the monthly chart here, we have 3 advancing white soldiers. It's followed now by another 2 good solid green monthly candlesticks. This one here had a long lower wick, that was bullish, but this one here has a slightly longer upper wick, that's slightly bearish, and this month is incomplete. This is for February. Now that January is complete, we can see that it did have a good, reasonable support from volume for upward movement, and so overall we're seeing some steady and slightly rising volume as price continues higher, and so now this is fairly bullish at the monthly chart level. RSI is still not overbought. There is plenty of room for price to rise or fall. MACD is fairly bullish and on balance volume is very bullish. Overall, this chart is much more bullish at this stage than it is bearish. What about the short-term picture? For the short term, for this upward trend, ADX told us at the high that it was very extreme. ADX was above both 35 and above both directional lines, but when oil has a strong trend, ADX can remain extreme for a really long period of time, and as you can tell, once it reaches into extreme territory, which was back here, it still continued for many, many more days to move even more extreme. It started to decline a little bit now, which could indicate either that price is now moving into a consolidation to relieve extreme conditions, or we could possibly have had a trend change. But ADX would only indicate a possible trend change if the directional lines cross each other. The positive directional line is still above the negative, still telling us that if a trend does resume, the trend at this stage would still be up. It is a lagging indicator. It is based on averages. As price moved upward, ATR was increasing. There was As price moved upward, ATR was increasing. The strength in the market supported upward movement. Now price is essentially moving sideways. ATR is still increasing, so there is some strength returning to this market. This is the one to watch really, really carefully next week. This resistance line is nearly horizontal. It's been tested 3 times. It has some reasonable technical significance. This support line has a very shallow slope. It's only been able to be just drawn though, so it has weak technical significance. However, if we get a breakout from this new consolidation zone from on-balance volume, that should be given reasonable weight. It should be taken as a signal as to what direction price is likely to move next. RSI has returned to neutral. There's plenty of room for price to rise or fall. Stochastic's also neutral. Look for it to swing down to oversold and price to find support if we are now in a consolidation. Bollinger Bands contracting at the end of the upward trend and now continuing to contract as price moves sideways could be either a consolidation after a waning upward trend, but equally as likely it could also indicate the start of a new downward trend. So it's not possible at this stage to tell which of those situations price is in. Let's look to on-balance volume this week for a signal. It should be giving us a signal by Wednesday, I would expect, this week. And that's all for me at the end of the trading week with your weekly analysis, and I hope that all of our members and viewers are having a fabulous weekend.